Welcome back to the Dividend Domain. This is episode 6 of the Robin Fire series, where I'm investing my paycheck to eventually be financially free and at some point using margin to float my bills. If you can, follow the Dividend Domain on all social platforms, TikTok, Instagram, and as you know, YouTube. I'm dropping the videos for the series, and then I also produce other content about ETFs, anything related to yield or investing on the dividend side of the spectrum for the most part. But let's get into today's episode. Again, Happy New Year. Thank you for joining me. I do appreciate everyone that's tuning in and commenting and participating in this journey. So let's get this out the way. I am not a financial advisor. The information presented is strictly for entertainment and educational purposes and does not constitute financial, investment, tax, or legal advice. All investment involve risk. Viewers should conduct their own research and consult with a qualified professional before acting on any information provided. Alrighty, let's move on. So in today's episode, we're basically breaking down what my strategy is. So I'm taking my W-2 income, and we're building this account to about, I'd say 15 to 20 grand, but we'll take it as we go and may make some adjustments before we start floating majority of the bills. Right now, I'm only floating one bill, which is my phone bill. My timeline to achieve this is 3 to 5 years to have financial freedom or be work optional. I'm using Robinhood as the brokerage for this experiment. We have a 5% interest on the margin. And right now what I'm doing is I'm using growth/value stocks like SCHG, Visa, Amazon, and that would be 40% of the portfolio, which I will drip. Then we have the high yield core, which is SCHD, SPYI, QQQI, which will be 30%. And then we have the high yield single, which is BTCI, NVIDIA, and WHO, which would be 30%. So that's how my portfolio is built. So basically, again, we're looking to pay bills and fund lifestyle out of the brokerage. All right. So in today's episode of Robin Fire series, we are looking at a $250 buy. Are you considering margin? Reviewing a comment from one of the videos, allocation tool. So we're going to jump into Snowball Analytics to use the allocation tool to see how we'll just disperse this $250. Update on a margin available to withdraw, and then my 2026 outlook with some important dates. I'd say hang around for the video because I have some important dates you want to, if you're an investor in January, very important dates you want to take note of. Just so we're organized, I am going to drop portfolio updates every Sunday at 8 a.m. I may throw in additional updates throughout the week if need be. If anything drastic happens or any subtle changes that I need to announce, I will. But expect to see an update every Saturday, 8 a.m. PST, right? Okay. So let's get into the $250 buy. So let's get actually, you know what? Let's go into the next step with considering margin. So if you are considering margin, I just kind of wanted to address a question, a comment from Banky. And I do thank you for tuning in the journey. And I know you're starting your own as well, but I thought this was a great question. These are some of the questions I had going into this experiment and considering whether margin was worth it for me, right? So it says, thanks for the video. I like your insights and style. I've been looking at different ways and styles to invest, and I will follow along to see how you do. Been wondering about the use of margin to float bills and invest 100% of income. Does it boil down to getting a boost in the beginning and then paying down with income again, like getting one paycheck at a 5% penalty, right? It says, I get that as you invest more and you can borrow more, but then you're basically borrowing 2 paychecks worth at a time. Or am I missing something? I would love to know more, and I'm just getting into accelerating my income after years of only investing leftovers, right? Thanks again for the video and any information you can share. Wish you great returns. Again, thank you for the comment, Banky. So to answer your question, technically, no, it would be one paycheck because what you're using to float the margin, that's that one paycheck that technically, if you want to consider it a penalty, but it's margin interest of 5%. So you'd be paying 5% on that bill or paycheck, whichever you decide to float. And it's completely subjective depending on your financial circumstances, right? So without margin, and this is how we typically operate, without margin, we take our paycheck, we pay our bills, and whatever's left over, we invest. What we're doing in this scenario, we're using margin in order to invest. Eventually, at some point, 100% of the paycheck is invested. Then you're using margin to pay the bills, and you can use that next paycheck to come in to either pay down margin or invest into more assets. Now, let's get into things you can consider, you should consider if you're looking into using margin. One of the main things is income stability. Without this, the strategy completely fails, right? So ask yourself, do I have multiple income streams? That's one thing that kind of gives you more stability with this type of approach. Does my income fluctuate? That's something else you want to ask. You know, if you're commission based, for example, I have commission salary, so I may have some large commission months and some are less. So my income fluctuates, right? So that's something I had to take in consideration before jumping into this. Maximum margin cap. Never float, for example, like you can say, all right, I'm never going to float more than 1 to 2 months of margin. Or you could say, I'll do a hybrid approach where I'll do 6 months of margin and 6 months of paying down the margin, right? And then number 3 is margin interest rate versus expected return rate. So your margin rate, you want to shop for a competitive margin rate. I seen, for example, I have Fidelity. I think the base entry margin rate is about 12%, right? That's too high. So I'm not using Fidelity to float margin. It just doesn't make sense, even though that's my primary account, right? So that's important. Your margin interest rate. Expected long-term portfolio returns as well, because obviously, regardless of what happens, you have to pay this interest rate daily, right? So then what we want to accumulates daily, and you're paying this interest rate monthly. So expected long-term portfolio returns. If I have a 5% margin interest rate, my objective is to get a higher return without compromising the quality of the assets that I select within that portfolio, because they also have, each asset has a margin requirement. So that's something else you want to be aware of. If the margin requirement or maintenance is higher, then again, that may be something that you want to shy away from. So the assets you select using margins also can kind of dictate the risk that you face with margin. Okay, and then stress testing your portfolio, down draws, and margin call tolerance. The market will drop. There's no evading that. It's going to happen. The market will drop. We don't know when or how or why, but we know the market can be volatile. NAV will fall. It's inevitable at some point. Depending on how well the fund's managed, that could determine if it's managed well and we have some type of recovery, or how it's structured, if it's even structured to be able to capitalize on some upside. That's something else you want to consider. In the time you buy, these assets are extremely important. If you're buying on a downturn, then or a drawdown, then obviously you have upside appreciation to consider. Something else is broker requirements or interest rate changes. You have to take in consideration the requirements to maintain the margin can change. The interest rates can change. The guidelines or rules for the brokerage could change. So always be aware that you need to be flexible. And how much does your portfolio have to drop before you're at risk of a margin call? You need to know that. And that goes back into margin maintenance or requirements for the individual asset, and just not being too bold on the margin you use. Number 5 is emergency liquidity. You want some emergency liquidity outside of the brokerage, usually like an emergency fund, anywhere from 3 to 6 months. All depending on your situation. Sometimes you may want longer than 3 to 6 months, especially if you're an entrepreneur, unemployed. Sometimes, not unemployed, but if you're entrepreneur or self-employed, it's usually best to have a better cushion if you know how business can go. You have the ebbs and flows of business, so you always want to give, but then it's a balance. You don't want to keep too much cash or dry powder. But my honest opinion going into 2026, of which we'll touch on a little bit later, there's some uncertainties that we need to be aware of, right? So it's always good to have emergency liquidity outside the brokerage to cover several months of expenses. And lastly, number 6 is discipline. Just don't be stupid, right? Don't over lever yourself. Don't buy risky assets, high dividend assets that aren't sustainable. You're chasing a yield that's not realistic. And what I've seen over, I'd say, the past 3 months since I've been on this journey is a lot of people transitioning from these ultra high yield ETFs because of the NAV decay, and it's just completely destroying your portfolio. So if I usually test something out. It's a very small allocation towards that, right? So if you're considering margin, this is some things to consider. It's not all of them, but this is pretty much. And what I did, you can go into Chat GPT, use the tools. I stress tested my portfolio in different scenarios, right? A decrease in yield, drawdowns at different percentage, at a 25%, 35%, 40, or 55%, floating margin only for 6 months, or doing 2 months at a time and letting it catch up. There's so many things that you can run quickly in Chat GPT to kind of give you an overview of what your risks are and how to approach that. So I strongly suggest use AI to your advantage, and it helps you kind of come to these conclusions, right? So let's get into it. We're going to go back. What are we doing? We're going to look at the allocation tool in Snowball Analytics and see how we'll disperse this $250. Okay, excuse me. So right here on the allocation tool, we have $250 for the deposit. You just search results, and this is balance of categories. So it's saying that I should invest, $100 in SEHG, QQQI, another $100, and then SPYG, another 50. So 50. So, and when you see, again, this $, it means that asset's below the cost basis. So I could also do it balance of asset and see what it comes up with. It gives me SPYG at $150 and Maggie at $100. So with that being said, I go back here and I look at my desired allocation for the portfolio, and does it make sense for me to do that? So I look into the growth. What I'm thinking about doing is, as I add maybe possibly individual stock, or looking at maybe adding more ETFs, I'm going to reduce my exposure to single stocks. Coming into this year, I don't want to have too much exposure to single stocks, or any one stock, I should say. So this may be reduced to 5% per single stock in this portfolio. And that's something I'm still determining. And then I might, like I said, keep a larger allocation for these ETFs. So, or I could look at possibly adding it to the higher yielders here in this segment of the portfolio. I just added Maggie. So we have about a little less than 10% in Maggie. I'm looking to get up to 25%. So this may be one that I want to add, because I definitely want to increase my income and get this yield up to about 20 to 25%. So that may be one of the things I want to include in this buy today. And then we got the high yield core, which is QQQI, SPYI, and one of the dividend kings of growth, the SEHD. So if I were to do that, I definitely want to contribute to something that's down. So I would add to QQQI. So let's go back to the rebalancing tool. I'll have to put that 250 in again. Sorry, it's 250. See results. Okay, setup. Now for me, let me see. I definitely probably might want to go with balance of assets, because I do want to put more in Maggie, which is a weekly payer, to increase my dividends on this one, or yield on this, dividends and yield. So, or like I said, I just added this growth ETF. So that's included here. QQQI. So I think I might actually go with balance of assets because I just added this one and I want to increase the percentage. We need to get up to closer to 25 for SPYG. And then for Maggie, I can add an extra $100 because we are down. And not only that, I want to increase the yield. And not only that, the payouts. This is a weekly compounder. So let's jump into Robinhood. So let's do that 150 on SPYG, and then we'll do another 100 on Maggie. So I did already add, you can see right here, if this loads, I added the $250. That additional 946 is from dividend payouts. So we double check 150 again, remember SPYG. So we'll go here and we're just going to do a market buy. All right, let's review and buy. All right, we are done. And let's go back and put that $100 in Maggie. So right now, I am total return. I'm down $5.09. That's a 2.55%. And let's put that $100. Review order. And share price is $52.49. My average cost is $53.86. Let's go ahead and preview. Buy. Alrighty. So what I'll do is I'll go ahead and update my portfolio later. But just to give you a quick view, this is where we're at on the dividend calendar. We're looking at about averaging 88 to as high as 106 some months. And as you know, that fluctuates. I think it's based off a trailing 12 months. So anytime those distributions adjust, it's projecting that for the months to come. And we're starting fresh here. So we're right here. So we haven't got any payouts, and I'll track that coming in the month of January. So a margin available to withdraw. We want to look at that. We were at $2,910, right? For margin available to withdraw. That's where we're at last month. And then that should increase based off of the additional purchases from the dividends and what I put in for the 250. So let's look at dividend payouts. So the last week we were about $44.53. That's a larger week because most of the NEOS funds pay out at that time frame. So we're looking at $44.53. This is only including week 2, 3, and 4, of which I've only documented so far, but that's $69.82. As you've seen in the dividends, we're looking at about $80. So that was including SPYI, BTCI. This is QQQI with $9.04. And then Maggie, the one I just added to give me more compounding, increase my yield. This weekly payout, 107. So we added to that. So that should increase. Here's Who at $8.56. And then dividends from YieldMax. We had the NVIDIA at $4.54, right? Okay, now lastly, let's get into 2026 outlook. These are some of the important dates. Take a screenshot of this, add it to your calendar. But for me, I'm taking more of a conservative approach and trying to DCA in the first quarter. I have a chunk of cash that I did want to drop into this portfolio, but I think I'm just going to wait and slowly but surely include this into the portfolio as we monitor these days. So coming up January 7th, Wednesday, which is coming soon, we have the ADP employment report. on January 9th, Friday, we have U.S. jobs report, which is important. If you look over here on Business Insider, it's been a crazy year. A lot of major companies like Verizon, IBM, Amazon, Starbucks, American Airlines, and more have had major layoffs. Then, recently we've had in Nebraska, Tyson lay off 3,200 workers, which I believe was 30% of the Lexington town. So that's huge. Just imagine that 30% of the workforce in the town laid off entirely. Right. So January 14th, we have Fed Reserve Beige Book. That's basically economics, labor. This is where we get the trends. Like we kind of get an idea of the labor trends and the state of the economy. We wanted to pay attention to that January 14th, and then 12th to the 14th earnings season, right? That begins JP Morgan, Bank of America, Wells Fargo, Citigroup, right? So that's mid-month. That's extremely important. That can, dictate the direction the market's headed. And then we have January 27th to the 8th, the FOMC meeting, rate decisions, and then press conference on January 28th. And then ending the month, we have peak earnings, right? So that week, we're the broad S&P, financials, industrials, healthcare, and tech. This is going to be huge. Like, depending on what transpires in January throughout these dates can strongly impact the market sentiment. So these are things that I have on my calendar and I'm taking in consideration as we go into 2026 and we're moving forward. So I think that pretty much concludes it. We've covered margin. You're considering margin, allocation tool, margin available to withdraw, our 2026 outlook. And then again, put on your post notifications, like, comment, subscribe. I will be dropping every Saturday at 8 a.m. PST, a portfolio update. And again, thank you for taking the time to tune into this journey, this experiment we have here. I wish you the best of luck in 2026, and good morning, good night, good afternoon, whenever you're viewing this. Thank you.